Hello viewers, welcome back. The Bank of England has just made a big announcement. Interest rates are going down. This is a significant move that could have wide-ranging effects on the economy and your personal finances. This is the second cut this year, and it's left many people wondering what it all means for their finances. With interest rates being a crucial factor in the economy, such changes can create a ripple effect that touches various aspects of our financial lives. Don't worry, we're here to break it down for you. Understanding these changes can help you make informed decisions about your money. First things first, what exactly are interest rates? Interest rates are essentially the cost of borrowing money. They are set by central banks like the Bank of England and influence the rates that commercial banks charge their customers. In simple terms, they're like the price of borrowing money. When you take out a loan or use a credit card, the interest rate determines how much extra you will pay back on top of the amount you borrowed. When rates are high, borrowing becomes more expensive. This can discourage people from taking out loans or using credit, which can slow down economic activity. When they're low, like they are now, borrowing gets cheaper. This can encourage spending and investment, which can stimulate the economy. This latest rate cut means your monthly mortgage payments could go down, and taking out a loan might be more tempting. Lower interest rates can make it easier for people to buy homes, start businesses, or invest in education. But hold on, there's more to the story. While lower rates can be beneficial for borrowers, they can also have downsides. Lower rates can also impact how much interest you earn on your savings. If you have money in a savings account, you might see lower returns, which can affect your long-term financial goals. So, buckle up as we delve deeper into the world of interest rates and explore what this latest twist means for you. We'll look at how you can navigate these changes, whether you're a borrower or a saver, and what strategies you can use to make the most of the current financial landscape. It's all connected. The Bank of England, or BoE as it's often called, doesn't just change interest rates on a whim. These decisions are the result of careful consideration and extensive analysis. There's a whole lot of thinking and analysis that goes into their decision. Economists and financial experts pore over data, trends, and forecasts to determine the best course of action. One of the main reasons for this recent cut is to boost the economy. By lowering interest rates, the BoE aims to make borrowing cheaper, encouraging both consumers and businesses to spend more. When rates are lower, people are more likely to spend money, which helps businesses grow and create jobs. This increased spending can lead to higher demand for goods and services, which in turn can stimulate economic growth. Think about it like this. When a shop has a sale, people are more likely to buy things, right? Lower interest rates are like a sale for the entire economy, making it more attractive for people to take out loans for big purchases like homes and cars. Lower interest rates are like a sale for the entire economy. But there's a catch. While stimulating spending and investment is beneficial, it can also have some downsides. Lower rates can also lead to something called inflation. Inflation occurs when the prices for everyday goods and services start to rise faster than usual. That's when prices for everyday goods and services start to rise faster. This can erode purchasing power, meaning your money doesn't go as far as it used to. Too much inflation can be a bad thing, so the BoE has to walk a fine line between stimulating the economy and keeping prices in check. They must balance the need for economic growth with the risk of rising inflation, ensuring that the economy remains stable and sustainable in the long run. It's a delicate balancing act, and the BoE uses a variety of tools and indicators to guide their decisions. By carefully monitoring economic data and trends, they aim to create a stable environment where businesses can thrive and consumers can feel confident about their financial future. So, the next time you hear about a rate cut, remember that it's not just a random decision. It's a strategic move designed to keep the economy on track and ensure a prosperous future for everyone. Speaking of inflation, the government's recent budget plays a big role in all of this too. The budget is like the government's yearly plan for spending and taxes. This year's budget included a bunch of measures aimed at supporting businesses and boosting the economy. While that's generally a good thing, some experts are worried that it could also push up inflation. Remember, when the economy heats up too quickly, prices can start to rise. It's like trying to blow too much air into a balloon. Eventually, it's going to pop. The BoE is well aware of these concerns, and they'll be keeping a close eye on how the budget measures impact inflation in the coming months. So what do the experts make of all this? Well, it's a mixed bag. Some are optimistic that the rate cut, coupled with the government's budget measures, will be just what the economy needs to keep growing. This is a welcome move by the Bank of England, says Sarah Coles, a personal finance expert. Lower rates will provide some much-needed relief for borrowers. However, others are more cautious. They argue that the rate cut might not be enough to offset the potential inflationary pressures from the budget. The bank is taking a bit of a gamble here, warns Andrew Bailey, the Governor of the Bank of England. We need to be prepared to act quickly if inflation starts to pick up. Section 5. Homeowners rejoice. But savers, brace yourselves. Now let's get down to the nitty-gritty. How will this rate cut affect you directly? The Bank of England's decision to cut interest rates has far-reaching implications for both homeowners and savers. If you're a homeowner with a tracker mortgage, you're likely doing a little happy dance right now. Tracker mortgages are directly linked to the BOE's interest rate, so your monthly payments are about to go down. This means more disposable income for you and your family, which can be a significant relief, especially in these challenging times. Tracker mortgages are directly linked to the BOE's interest rate, so your monthly payments are about to go down. This reduction can translate into substantial savings over the course of a year, allowing you to allocate funds to other essential areas, or even save for future investments. For those with fixed-rate mortgages, you won't see an immediate change. However, this doesn't mean you should feel left out. When your fixed term ends, you'll be in a good position to snag a lower rate when you remortgage. This could mean lower monthly payments in the future, giving you more financial flexibility. But when your fixed term ends, you'll be in a good position to snag a lower rate when you remortgage. It's a great time to start planning and discussing your options with a mortgage advisor to ensure you make the most of the favorable rates when the time comes. Savers, on the other hand, aren't going to be as thrilled. Lower interest rates mean banks are less likely to offer generous returns on savings accounts. This can be disheartening, especially for those who rely on interest income to supplement their finances. Lower interest rates mean banks are less likely to offer generous returns on savings accounts. This can impact your savings growth, making it harder to achieve your financial goals. However, it's important to stay informed and proactive. It's a tough pill to swallow, but don't despair just yet. There are still ways to make your money work harder for you, even in a low interest rate environment. Diversifying your investments and exploring alternative savings options can help mitigate the impact of lower interest rates. There are still ways to make your money work harder for you, even in a low interest rate environment. Consider speaking with a financial advisor to explore options such as stocks, bonds, or other investment vehicles that may offer better returns. Staying informed and adaptable is key to navigating these changes successfully. Section 6. Good news for borrowers. Loans just got cheaper. If you're thinking about taking out a loan, whether it's for a new car, home improvements, or that dream holiday, now might be a good time to do it. With interest rates lower, you'll pay less in interest over the life of the loan. But remember, it's important to borrow responsibly and make sure you can comfortably afford the repayments. Lower rates can also be good news for businesses looking to invest and expand. Cheaper borrowing costs can make it easier to take on new projects and hire more staff. It's a ripple effect. When businesses thrive, the whole economy benefits. Section 7. The economy's tightrope walk, balancing growth and stability. The UK economy has been on a bit of a rollercoaster ride lately, and the BOE's rate cut is just the latest twist in the story. The economy isn't growing as fast as it used to, and there are concerns about the impact of Brexit and the global economic slowdown. The BOE is hoping that by cutting rates, they can give the economy a much-needed boost. But it's a delicate balancing act. They need to stimulate growth without letting inflation get out of control. It's like walking a tightrope, one wrong step and it's all over. Section 8. Will prices keep rising? The inflation puzzle. Inflation is a bit like a sneaky thief. It slowly eats away at the value of your money. When prices go up, you can buy less with the same amount of cash. The Bank of England's target is to keep inflation around 2%. That means prices, on average, shouldn't rise by more than that each year. But with the recent budget measures and the rate cut, there's a risk that inflation could start to creep higher. The good news is that the Bank of England is keeping a close eye on things. If inflation starts to spiral out of control, they have the power to raise interest rates to cool things down. Section 9. Jobs, jobs, jobs. What does the future hold for workers? One of the biggest concerns for people is the impact of all this economic uncertainty on jobs. When the economy slows down, Businesses can be forced to make tough decisions, and sometimes that means job losses. However, the government's budget included a number of measures aimed at supporting businesses and creating jobs. And the Bank of England's rate cut should also help to boost the economy and create more employment opportunities. So while there's always some uncertainty about the future, the outlook for jobs isn't all doom and gloom. Section 10. The big picture. Navigating uncertainty in uncertain times. Let's face it, the economy can be a complicated beast. There are so many factors at play, and it can be hard to keep up with all the twists and turns. But here's the good news. You don't need to be an economics expert to make smart financial decisions. The key is to stay informed, be aware of the potential risks and opportunities, and plan accordingly. And remember, there are experts out there like yours truly who can help you navigate the financial maze. Section 11. Your money matters. Making smart choices in a changing world. So, what does all this mean for you and your hard-earned cash? First and foremost, don't panic. The rate cut is just one piece of the puzzle, and it's not necessarily a bad thing. If you're a homeowner, now might be a good time to review your mortgage and see if you can snag a better deal. Borrowers could also benefit from lower interest rates on loans. Savers, on the other hand, might need to explore different options to make their money work harder. But don't be tempted to take unnecessary risks in pursuit of higher returns. The most important thing is to make informed decisions that are right for your individual circumstances. And if you're ever in doubt, don't hesitate to seek professional financial advice.